Kalimera Zeolus, Kaikalos Irtatesto, Economica. Welcome everybody to Economica, all about economics and finance. And thanks for all of you that are watching my videos. And if you just click on like, that helps the YouTube algorithm to push the content to more people as possible. And today I have another very interesting content to provide you. I have to say very interesting, and with a lot of things. And for as much data that I worked through, as many models that I worked through, one day of continuous recording won't be enough, because it's very high quality stuff, high level stuff. And so what are we talking about today? So basically, I think everybody can be sure now that we are going to have a stock market correction of some sort because of tariffs or something like that. But the thing is that the correction has been technically timed, let's say. In what sense? So yesterday, I have here the chart of FTSE MIB, so the most common benchmark for Italian, the Milano Stock Exchange. So where all the blue chips are listed is the FTSE MIB, and I believe we are going to have a very significant correction in the Italian equities, and I have no confidence at all in that the government of the day they're gonna last any longer. I presume that their days are numbered, and so there's going to be a repricing of all the stock market, and then another scenario will open up. But I strongly believe, I don't have any certainty, but I believe that the government days are numbered. They're not going to see it through any longer, because it's not sustainable. But anyway, we see here, you see here that the equity market, Italian equity market, the FTSE MIB just pinched here against this Fibonacci level, the 40,950 or thereof, and it just reversed back. So you have a so-called technical signal of a Fibonacci retracement, which is the widest Fibonacci retracement that you can think of, because it's from top to bottom, it's the whole trend, the whole price action of the FTSE MIB Index. And we see here that we are pinched again against its level, which is the 7860 Fibonacci level. And you basically here we are at pretty elevated levels. So from here to the historical all-time high, we are 18-20% away, and the market has rallied from the bottom some sort of 200%. That's a multi-year trend, but let's see here. Yeah, let's say in the last couple of years we have 100% rally or something like that. So it's a huge after the Q4. But at the end of 2022 we had a broader global equity market correction, and then the rebound has been 100% up, all in equities. But we are here, that's the time frame, it's a monthly time frame. We see that these bars here, they are in technical terms are defined doji bars. So we have basically the body of the candle, it's here, and it's basically forming a small area of sideways consolidation, and then it would almost for sure drop down, follow down with the retracement, and we can basically, no, that's not what I needed. So basically we will have retracement of this sort, so more or less. Okay, so I believe that just looking at the chart, but I will give you all the details in that regard. We are going, at least we are going here about from top to bottom, like the whole Fibonacci thing. We are going down around 14%, 15%. In the correction can be deeper than that, but it's gonna take many months, like more than 1 quarter. You can see here that on a monthly time frame, the RSI also is 72, so we are slightly overbought on technical levels, more or less. And you can see it basically from the 40,000 to the 48,000, we are about 20% away, more or less. And so the market, it's a lot overvalued for what are the macroeconomic performances of the Italian economy. I saw that recently there has been a jump of unemployment, and so it means that the economy, it's probably slowing down, and the economic policy, it's wrong, and there are some atavic problems in Italy of very low wages, exploitation in the labor market. So these, of course, they are not good for the economy. They are not good for basically disposable income, consumption, investment. So the whole thing it grinds to a halt when basically more and more people they don't have enough disposable income to afford living and doing any consumption or investment. So for sure we are having a stock market, equity market correction. That's also driven by other factors, which are tariffs coming for Europe as well. So we see here, yeah, we had yesterday the exact pinpointing of the Fibonacci retracement. The market is reversing, and then we will see what will be the price action at some point. I don't like support and resistance level. Fibonacci retracement is something that it's more linked to a mathematical series of numbers, so that's more reasonable, more or less, to have as a point of reference frame. And from back in my previous life, from my previous studies, I published on a website called academia.edu a paper in forecasting the Q1 2025 of this year stock market correction. And among all the models that I had to implement, I have a very simple chart that basically identifies the seasonality of the stock market seasonality. It's very simple because it comes out from the those are the EVTs. Okay, bear with me 1 second because I must find it. Okay, so we have the seasonality, seasonal volatility patterns and decomposition. Okay, and we have here what I was saying is very simple chart. So everybody is the month of the year, and that's in the model. It's interpolated for the main US indices like the Dow Jones or the S&P 500, and we see that the July bar, it's the least volatile seasonally. I mean, taking the data set from 2007 to 2024, July seems to be the less volatile month, but then volatility grows in August and September. It's very high volatility in October, November. Then the volatility goes down in December because we have the year-end rally. Okay, and we see that we have a lot of volatility in March. So the Q1 is particularly volatile, and it peaks with it has a peak of volatility, seasonal volatility in March. So what I'm saying is that we are almost by the middle of July, and we are having some exogenous signal of tariffs coming. Those tariffs will kick in by the beginning of August, so this follows exactly the seasonality pattern that volatility starts to pick up again in July, because July is the lowest volatility month, because the United States, they celebrate Independence Day, so of course there is no mambo jumbo in markets. So I believe that we are going to have a retracement now, and more volatility will follow through in August, September, October, and we will see if the government in Italy is going to last any longer. I don't think so. I think they're going to be knocked out with very brutal force. Unfortunately, that's the way it has to be. And we see here that the FTSE MIB is quite volatile. In fact, from all my modeling, I have a huge quantity of data that basically shows how the FTSE MIB is very volatile, and it's not an easy market to deal with in terms of equity market. And I will tell you in a moment. Just let me get organized. Okay, so I did implement a Jump-Diffusion model on the data. So I took the data from the year 2000 up to yesterday or today, to the most recent data point. And so basically what we see here, we have the Jump-Diffusion model. It's another measure of volatility, which it's somewhat quite important or useful, because it helps understand the fat tail risk in the market, and basically how the market behaves. So, or an individual financial asset that you are considering. It can be currencies, a commodity, a bond, the yield, the stock price, or the broader index. The Jump-Diffusion models provides you a series of parameters which are very, very, very useful indeed, and very important to know. Just bear with me 1 second, because I need to take my data properly. Okay, so we have here the annual mu, sigma, lambda, gamma, delta, and the Sharpe ratio, and the jump contribution. So what we see here, that the FTSE MIB has a lambda parameter of 134, almost 135. So it means that the Jump-Diffusion models account for 134 times in a year that the broader index has a very large move. So the jump it can be identified with the opening up. So if you have a market or some stock in pre-market, they are up or down 5 or 10%. You see that basically you have a gap at the open, and so the market opens lower by some 2%, 3%, 5%, and so the FTSE MIB has a very high annual lambda parameter, like compared to I don't know, some other stocks like that have an annual lambda of 25. We see that the broader index has an annual lambda of 134. The same is for the FTSE MIB All Share. And for example, Banca Monte Paschi di Siena, it has a very high lambda parameter, and yes, Azimut has a very large lambda parameter. SG, the Société Générale, Deutsche Bank has a very large lambda parameter. So we are in the magnitude of a higher frequency of jump or gaps in the pricing of the financial assets, and these gaps, they have an annual volatility of 0.3 and an annual average of 0.21. The gamma parameter is a negative 0.26, and the Sharpe ratio is positive, and the jump contribution is 0.68. So all in all, the 0.68 equates basically to 68%. So what it means is that when basically the FTSE MIB, it's a very volatile index, and it has a high frequency of let's call it jump or jump diffusion, like market which gaps a lot with big large percentage declines in the value of the index, and if we have a period of correction, it can be as deep as 60%, or in other words, the I lambda parameter, the contribution of the 134 jumps frequency in a year of 252 business day, those contribute by 63% in the overall volatility of the index. And to put it into context, let's take the volatility data. Bear with me, because I have all the data and I can tell you exactly how it works. So basically, if we put together the Jump-Diffusion model with the volatility parameters, like the 7-day, the 21 days, annualized volatility, all these parameters here, we see we gather more evidence which are consistent with a very volatile index benchmark, which is prone to large drawdowns. Okay, that is visible also in the VAR numbers, in the expected shortfall numbers. So basically, the return distribution of the FTSE MIB, they have very fat tails, so there is a very high tail risk in the index. That means that underneath the index, the 40 stocks which are the components of the index, most of them they have tail risk, which is not negligible. It's very high. It can be, tail risk can be by 5, 7, even 10% and more. Okay, you can have stocks like such as Campari, which is very volatile. This one, and it carries a lot of tail risk. And these stocks, they are also overpriced, because the market, the overall index benchmark, has been flooded with speculative money, and now it's overpriced. And many of these stocks, as I will show you in a while, they have a higher price to earning ratio than 12 price to earning ratio, so they can be prone to corrections, to stock price correction. And what basically the normal investor needs to know, but almost surely they don't have the instrument to see these things, is that those stocks, they have a very fat tail risk, a high tail risk, so they can be very volatile, and the drawdowns, they can be very large. These are idiosyncratic characteristics of the FTSE MIB. And so why I'm saying that? Because, for example, the average daily volatility, we are already talking about 1.5%. So on top of the average daily returns, the FTSE MIB in itself is volatile by 1.5%. It's not extremely high, but because there are stocks which are more volatile, like I believe that's UniCredit, we are talking about daily vol of 3.6%. That's why I explained that the stocks which are into the index, they are volatile themselves as well. So if there is a drawdown, as there is going to be, these stocks, they are going to go down, and the index is gonna go down. There's gonna be a drawdown. Okay, capital outflows. There is no way. So weekly volatility 3.3%, monthly volatility 6.8%, and the annualized vol, okay, it's 23.4%. So an annualized vol of 23%, 24%, and also a weekly vol of almost 7%, 6.8%. That means that these vol numbers, they are not negligible for being an index, because the index is it's composed, it has 40 components. So index, they should be not so much volatile, because it takes a lot of money to move the index around. So that's why the individual stock, which has a smaller market capitalization of the whole equity benchmark, it takes less money to move around the stocks in terms of volatility. It takes more money, a lot more money, to move around the whole index. Okay, especially the FTSE MIB, which is not traded very often. It's not a retail product. Okay, most of daily traders, they trade the United States market, so it means that there can be liquidity issues or tail risk issues, and institutional investors that they make a sudden change in their asset allocation, and then they come to the conclusion that they have to sell the equities that are listed on the FTSE MIB because they are overpriced, and there is no more the economic case that supports the growth of the equity. And the almost 24% annualized vol, it means that there are significant price swings up and down. Also, the 6.8% weekly volatility for the index, it's a large number. I mean, this would be in line with many other, with the DAX or the Nasdaq. Probably the Nasdaq is much more volatile than the FTSE MIB, and so we're not saying anything extraordinary. But is to bear in mind that when we have this kind of price action, it means that volatility is starting to build up, and then that you're going to have large drawdowns, large movements in the overall index. And also there are other parameters which are very important, because we have here the average historical volatility for the last 30 days or 90 days. So we see that in between the last 30 days or 90 days, the average historical volatility has been between 13 and 23%. So it hasn't been low volatility. There is volatility. So it means that the index has tail risk. Okay, Italian equities have inbuilt tail risk. Okay, so the rolling vol going from 1 week up to 3 months or 6 months, because we have 21 days, 63 days, 126 days. Okay, so the rolling vol, it's of a minimum of 13.5%, and it goes up to 22%. Okay, so the rolling volatility, of course, is a sort of moving average of the smoothed moving average of the 7 days or 21 days, 63 days, 126 days standard deviation, right? So in this case, for example, we can compare the fact that the average historical volatility in the past 3 months is 22.6%, which is in line with the rolling standard deviation, rolling volatility of 126 days. Okay, so between if we smooth the average in a 3-6 months period, we are consistently on the 23% volatility, tail risk for the index itself. Okay, so that's not negligible. And basically, if we check the percentiles, we see that the highest percentiles, the volatility is the 75th percentile. That means that there is higher frequency of having a 24% average volatility for the overall index, because it's in the highest percentile, which is the 75th percentile. Okay, and the current percentile is 19% and change, more or less. So we are approaching the 20% and above tail risk in volatility for the whole index. And because we have past data, and we see that the average 30 days and 90 days, the volatility has been between 13 and 20%. And here we have the EDFs here and here. These are EDF, so we have some other benchmark to confront with. They are more or less in line with the 12, 13 to 15% vol. So there is an average vol between 12 to 25%, whether it's the FTSE MIB or the EDFs, and that is consistent with tail risk. And as we are speaking now, the index, it's minus 1.6 56 or 58%, which is consistent here with this data, which is a daily average volatility of 1.5%. It's exactly consistent with the parameter. So I am myself very confident of the data that I have, because they've been worked with historical data, and so I know what I'm talking about when I say that there is tail risk in the market, and when the stock market correction period starts to build in, and the volatility becomes more persistent, then these sorts of equities, they tend to be very volatile, and they can experience very large drawdowns. And if we go back to the other parameters of the Jump-Diffusion model, we see here that the lambda parameter is 135, and the average size of the jump, which is the annual gamma parameter, it's about 26%. Okay, and the overall contribution is 63.2% more or less. So that means that the FTSE MIB, the index, it doesn't behave with the gradual slow repricing, but the Jump-Diffusion model points out that basically the high frequency of jumps in the pricing of the index, that means that you don't have a gradual decline in the market, but you have sudden large shocks or large repricements, and these shocks, volatility shocks, they contribute for 63% to the overall market volatility. So it's not here like 10%, it's 63% of the frequency of jumps, and the average decline is 26%, not in a day, but the 134 times in 252 days, it generates a 26% drawdown, let's say, and for the overall index volatility, it contributes to the 63% of volatility, negative volatility shocks, negative shocks in the market. And we can then, we have here the Jump-Diffusion model. We can go and see the other stocks which are somewhat volatile. We are in the ballpark here, like Recordati, Snam, Mediolanum Bank, Diazorin, Medio Banca, Interpump, Beaver Banca. So bank stocks, they are quite volatile, and a lot of liquidity risk, for example, volatility risk is on these stocks, which is a penny stock like Telecom. The utility, it's very volatile. It's a 26 cents or 30 cents penny stock, but basically it has a lot of volatility. And so for example, what are the like bank stocks which can be perceived as solid investments? Bear in mind, like Banca Mediolanum, Mediobanca, they are very volatile. There is a high frequency of jump diffusion, so the stock price doesn't decline slowly. You have minus 0.5 or a slow adjustment in the price, but you have a sudden negative price move, and you have those days which are VAR days, so you have a large move of minus 3, minus 5, and the stock price basically has a correction which is sudden and large all at once. Okay, it's not a slow going adjustment of the price, like a slow drift in the market, but you have a sudden jump in the price, and then you have a correction all at once. And you basically, any retail investor can find that he's holding shares of Banca Mediolanum or Mediobanca or Snam and or Beaver Banca, and then they see that the stock basically has a large decline in one day, and they are disappointed, or they can start to panic. That's also for other banks. Yeah, if we take Deutsche Bank or Societe Generale, which are not, one is a German bank, the other is a French bank, we have the same problem. We have 141 jump diffusion. We have a negative, like Societe Generale, it has an average drawdown of minus 21%. So the only thing that we see that the contribution of the overall volatility is 17.5%, so it's not like a large contribution compared to the FTSE MIB, which is 63%. So what that means is that the stock price of Societe Generale or Deutsche Bank, it can jump, but the overall jump can be 1 day, 2 day large correction, but then it doesn't follow through with with longer periods of stock price drawdown. Okay, there are other factors that contribute to that. Maybe I don't know, dividend payments or some announcement which are idiosyncratic of the business or the corporation and stuff like that. So from a financial engineering point of view, you have a high frequency of lambda parameter, so a lot of jumps. So a lot of times the stock has showed that the stock price has showed a jump, a negative shock in the price, which is large and sudden shock in the price, but that doesn't persist a lot as a long drawdown period. Okay, so that's the Jump-Diffusion model. It's a very useful tool to have in order to understand risk management around stocks, indices. They are not but around stocks, so that basically you can be more or less prudent in your stock portfolio allocation. Like here, for example, we have keyring. Okay, keyring, LVMH. So we are talking about European equities and ING. Okay, so these three stocks, they have very high jump diffusion, and the annual gamma is about 1.2% more or less, and but sorry, I made a mistake, because that's the Sharpe ratio. Sorry, so let me double check. Okay, I made a mistake. Okay, so also for Deutsche Bank and Societe Generale, okay, because I couldn't see. So okay, the jump contribution is 73%. Okay, so I'm sorry, I made a mistake because I'm studying this stuff now. Yeah, so there is a higher lambda parameter, and the contribution of the lambda parameter for these stocks is of 73. That's the data, 73%, almost 74%. That's for Deutsche Bank or Societe Generale. Yeah, we see here the lambda parameter is 141.7. The contribution is that one. That is the Sharpe ratio. The 0.17 is the Sharpe ratio, which is the profitability ratio, some sort of. So the contribution is 73%. So of course the higher is the lambda parameter, the higher is the contribution to the overall volatility of the stock. And I was saying, I hope not to make any mistake, that also stocks as keyring, they have very high lambda, and they have a very high contribution. Like that's LVMH. I don't know why I made some mistake, but anyway, so the contribution is 76% to the overall volatility of the stock price. Also the luxury stocks, they have a very high lambda parameter, so there is a high frequency of jumps in the stock price, and the contribution to the volatility is 76%. So this sudden jump in the and sudden correction in the stock price, which are large and come all at once, they are more frequent than what they should be, and they inbuilt, they bring a 76% contribution to the overall framework of volatility of the stock price. So if we go back to the average vol numbers, okay, let's see keyring here. Yeah, keyring, it's the average daily volatility is 2%, the weekly vol is 4.7%, the monthly volatility is 9.6%, the annualized historical vol it's 33%, the average historical volatility in the last 30 days to 90 days has been 46%. So stocks, they are very volatile. By no means they are safe investments. And the rolling volatility from a 7-day period up to 126 days, it spans from 34 to 47%, but the 21-day rolling vol, it has a 60% average volatility. So that means that you have a higher, so the stocks, if it's volatile in the first 7-day business periods, and then you can expect that in the whole month, because 21 days it's a whole month of business, volatility can go to 34% up to 60%. So it can be very, very volatile in a shorter period of time compared to the 63 days or the 126 days. And that data point is consistent with the Jump-Diffusion model, because the Jump-Diffusion, it works on the sudden large price shocks. So here on keyring is a very good example of understanding how volatility works, and volatility builds up and it's very high in the short term, and then you have the panic effect on investors because you have a sudden high volatility regime, so the volatility index goes high, very high in 1 day, 2 days, in 1 week, and then basically the whole volatility effects basically ripples through all financial assets, especially through stocks or ETFs and indices. And so you have a build up between the 7-day and the 21-day, which is basically 1 month volatility. It builds up very, very high. And during those 21 days of business, you can have a jump in the price. So you see that keyring in the pre-market open goes, the last closing price was 260 euros, 205 euros, and then you see that it opens 190 euros. So the stock price is down 15 euros or something like that. You have a huge jump in the price, so you have a large shock in the price, and you have a large high volatility shock in the price. And what is the diffusion of that jump in volatility and in the stock price, and how that jump basically builds in the volatility. So keyring is a very good example of how volatility works, because you have a build up between the 7 and 21 days rolling vol, and you see that the 21 days is 60%. It's a very high number. So keyring is a luxury stocks. Everybody say it's a secure investment. The data, they tell the opposite. It has very high tail risk. So when you invest in keyring as an equity investor, you are carrying a lot of risk, a lot of volatility risk, up to 60% in the space time of 1 month of trading. So it's very volatile, and then you see that volatility is persistent in 63 days or 126 days, and it's 46, 47, 48%. So those are very high volatility parameters, yeah, compared to 10, 20%, which you can basically deal with some hedging, some option hedging for the when you have a portfolio allocation and say, okay, I want to hold banks and luxury stocks, and you think that you are in a safe boat and nothing is gonna rock the boat. I'm sorry, you picked the wrong stock, because keyring, it can be very, very volatile in a short period of time. You have a huge volatility shock, the price jumps, and you are left basically in negative equity. And in that respect, my work, it's very, very important for me to understand the idiosyncratic factors of these, the FTSE MIB components, also these other European blue chip stocks. That's from the point of view of financial engineering, so that it's pure stock price and volatility. So we are not talking about what products makes keyring, what are the revenues, the profits, and the net income, the cash flow, and stuff like that. I'm not talking about that, okay? So I'm not doing a due diligence on keyring balance sheets, but I'm analyzing from a quantitative price volatility measure if keyring it's a safe stock to hold or not. To me, it seems not a safe stock, and it can give you some very nasty surprises probably if the market is volatile. And so back to our FTSE MIB, let's go and check again. Okay, yeah, we are solidly below the 40,000. I think we're going to raise the 900 mark. We're going to go to 39 and a 39.8 handle. Actually, it has recovered a little bit. Now we are at minus 1.4%, so we are stalling a little bit, probably because we are approaching the United States opening and futures market, they start to kick in with the volume. So that's a bit of wait and see. But nevertheless, the FTSE MIB is minus 1.4%, and we have here the daily vol, it's 1.5%. So it's in line with the parameters. So what else we have to consider when we have tail risk, and we have we can have a sudden a price move which is very large, and we have a shock in the price which can be a negative shock, sometimes can be a positive shock. But let's consider the risk management and the tail risk of the market, which is very volatile, and then investors, they find themselves basically, I don't want to say losing money, but holding something that is declining in value. Then we have to consider, for example, the VAR numbers, okay? Because bear with me, the VAR numbers also basically reinforce the concept of very high tail risk for which is inbuilt in the FTSE MIB. So that's why I'm basically I want to give you the concept that the FTSE MIB as an index of equities is very volatile, and it's in its whole price history, it has performed with very large drawdowns. So the Jump-Diffusion model basically bakes in what are and gives out the signal or the data point that the index has very high tail risk. So from a risk management standpoint, once volatility starts to kick in, then when we see the VAR numbers, we see that we have a very large tail risk, and that's not very difficult because we have the thing just in front of our eyes, like the VAR 95. Oh dear, come on, sorry about that. This machine doesn't want to cooperate. Okay, oh dear. Okay, so the VAR 95, it's 2.4%. So there is a 5% probability, which is a large probability, that you have a one-day decline of minus 2.4% for the whole index. Okay, and when we go down to the VAR parameters, we see that we have a tail risk of a 7% drawdown, or a 4.2% drawdown, or 3% drawdown, which are quite large for a whole index, because the index moves according to the whole 40 stocks which are listed in the market. So you need to have a lot of volatility also in the stocks, and we saw that like Italian banks and some other stocks, they have they can be very volatile, they have tail risk, and so there is inbuilt volatility risk in the market. And for this reason, I'm basically preempting the space and say, okay, we are going towards the implementation of tariffs. The market is starting to reverse. Seasonally, July it's subdued volatility, but then August, September, October, November, volatility carries up and goes higher. Okay, so given all these factors, then I would reasonably expect, like we see here in the chart, a sharp drawdown. So you have very high volatility in short period of time, 7 to 20 days volatility. So that can repeat itself again. As a market, they function this way. You have to sell what is overpriced, you have to buy what is underpriced, and according also how the macroeconomic variables, they are changing. So investors in asset allocation, they would probably sell stocks which are in the economic sector that are penalized, or they have to absorb tariffs, and they probably will put their chips on eventually some other industries which are not they don't have to absorb the tariffs. I don't think they will find this kind of arbitrage but everything is possible because in the market there is always arbitrage, especially the high frequency trading firms. They exploit this arbitrage in milliseconds. Okay, they see the spread in the price for the same stock between an exchange and another, and then they have an arbitrage. They buy at a lower, a marginally lower price in one exchange, they sell it to a marginally higher price on another exchange, and that's the arbitrage because it's a secure profit without any risk. Okay, but here we have a lot of tail risk if we are exposed to Italian equities. And on top of the VAR numbers, so we have a huge tail risk of 7% or 4.2%. The expected shortfall, it additionally gives some consistency to the tail risk, because we are between 7% and then an additional shortfall of almost 10%, 9.9%. So we are around the 18% market drawdown, which is totally consistent with the jump diffusion parameters, okay, of 26% on average drawdown that derives from the large shock, sudden shock, and in the market. It's so the VAR numbers basically they go hand in hand with the jump diffusion model and with the volatility numbers. Okay, here we have the volatility and basically the VAR numbers and the expected shortfall on a very large tail risk. We are between 10 to 18% in some very large scenarios, okay, which can be extended in a period of 7 to 21 days of market drawdown. So it's reasonable to expect a 10, 15, 18% move, okay. The VAR, so the VAR is for 1 day. I don't think that in 1 day the market goes down to 18%, but if we basically look at the chart, we have measured that we are the next the nearest Fibonacci level, the 61.8, the 61 level, 0.618 level, it's here, the 35,000, and we are more or less 14-15% drawdown, which is entirely consistent with the jump diffusion model. Okay, on average we have a 26% correction, or the volatility numbers. The average historical volatility in last 30 days is 13%, 90 days 22%. So the annualized historical volatility is 23%. So here, okay, average historical volatility 30 to 90 days, we are between 13 to 22%, which that is very consistent with a 14-15% market drawdown. And we have VAR numbers which tell us, okay, you can have a 2% drawdown in 1 day, which can happen. It already happened many times in the for the FTSE MIB. Now, we see here the chart. These are all the returns from 2000 to 2025. So the red line is the EVT VAR 99, and we have a 90% peaks over threshold. So it's not a 95% peaks over threshold, but nevertheless we see that we have many occasions when we go above the 99 VAR. So there are quite a few days, quite many times, the FTSE MIB has ticked that 1% probability, which is not a possibility, 1% probability that you have a 1 day drawdown of 4.28%. Yeah? EVT VAR 99. We are talking about a decline in 1 day of more than 4%, larger than minus 4.28%. Okay, so that's why there is a lot of tail risk. Okay, exactly, it's 4.34% for the EVT numbers, and you can have an expected shortfall of an additional 5.87%. And you see here these big bars, 1 day almost 20% down. So it's entirely consistent with this data, and that's COVID. Okay, in 2020 it seems that the correction was so sharp and short in time that the FTSE MIB saw an outflow of almost 18% in one day, which is bonkers, and it's full financial crisis. Yeah, so that means the whole of the whole capitalization starts to go out. Almost 20% of the entire FTSE MIB capitalization goes out in one day. So that's a lot. And here we have subsequently of 2016, and we have almost closer to 15% in one day. So that's another huge shock in the price. Yeah, and everything that is above the red line here, these are all of this context, yeah, this magnitude. 4.34% daily loss, with an expected shortfall of 5.87%. So these are very large tail risk for the FTSE MIB, and so that means that it's a risky asset to have and to manage, and that means that Italian equities, they are somewhat volatile and risky to have in a portfolio. Okay, so I have the VAR numbers for 60 between 60 financial assets, but let's see if we go back to the Jump-Diffusion model. We can try to see what are the very volatile stuff. Okay, so BMPS is very volatile, Monte Paschi Siena is very volatile, STM Microelectronics is a very volatile stock, BP, the Banca Popolare of Sondrio, it's a small bank, but it's very, very volatile, it's a very risky asset, and Campari is very volatile. Okay, Saipem is a very volatile stock, so yeah, that one. Okay, it has a smaller jump diffusion parameter, but so probably Saipem is a bit safer, but STM, banks, generally in banks, they are pretty much volatile. Banca Popolare Sondrio, Generali Bank also is quite volatile. Yeah, all this block here, Bruno Cucinelli, Kering, LVMH, so also the luxury stock, they are quite volatile, and also the Banca Mediolanum, Mediobanca, they are volatile, Deutsche Bank, Societe Generale. So the components of the index, at least the Italian blue chips, they are very volatile. Enel, that's the utility company, it's 148 lambda parameter, is very volatile. So that means, of course, that stuff builds into the volatility of the whole index. So if we see the volatility parameters of these stocks, let's see the average historical volatility in the past 30 days. Okay, we have here, okay, so we have Kering, we said it's 46%. Let's see what which are, here we have a 45, which is STM Microelectronics, and that confirms it's very volatile in the past 30 days. Banco Monte Paschi di Siena is 31% historical average historical volatility in the past 30 days, and 41% in the past 90 days. So BMPS, it has been very, very volatile. And also LDO here, which is Leonardo, has been very volatile. Some other stocks, 25%, that's Deutsche Bank, Societe Generale. Let's see something which more meat on the bones. So Amplifon is 29%. Stellantis, which is the automaker, it's 43% volatility in the past 30 days on average, the historical vol. Busi Unicem, 29%, so that's somewhat of move in the market. Campari, 32%. Prysmian, 33%. Oh, that's another luxury stock, Ferragamo, 35%. Yeah, again with Kering, 46%. So what we see here is that luxury stock have been very volatile in the past 30 periods, in past 30 days, or in the past 90 days on average, an historical volatility. Some banks stocks have been very volatile, because we have BMPS, they are talking about merger between one bank and the other. I don't know all the nuances of this. I saw that UniCredit has made a bid of Commerzbank, but I suspect that here we have UniCredit, so the past 30 days, 27%. The average historical vol has been 40%. So UniCredit is a stock that, if you are a UniCredit investor, you have to be really aware. You have to hedge your risk, because if the deal doesn't go through and UniCredit, let's say, doesn't take Commerzbank, or they are either forced to sell their stake into Commerzbank, then you will have a huge volatility event for the UniCredit stock price. Yeah, they're gonna be hammered in the market. Yeah. You'll have investors like enthusiastic hammering the UniCredit nail, which is, you fucking nailed it, and then it all messed up Commerzbank, and then that can be very, very volatile. And the past 30 to 90 days, we are in the range 27-40% volatility. Let's see the rolling vol, how it behaves. We are between 37, yeah, it has been very much steady around the 37% average rolling vol. So it's very consistent. The data are very, very consistent. And yeah, the 75th percentile, yeah, and the current percentile, it's 35% vol. So we are bang on average, but it's not low volatility. Yeah? UniCredit it can become a very volatile stock, because they put themselves into this mumbo jumbo of acquiring another bank or bidding with the BMPS. I don't know what's so there is I think I see a market risk emerging in bank stocks, and if this basically matches up with the volatility in the FTSE MIB, that is a perfect recipe for a market drawdown. Yeah, I think that is very much the case. So again, Monte Paschi Siena is a risky stock, Kering is a risky stock, UniCredit, keep an eye on UniCredit, can be very volatile, especially for that stuff of the merging with Commerzbank and all that thing. Also Banca Mediobanca, very volatile, because there are all this this maneuvering of acquiring or merging with the other banks, that in the end they bring a lot of speculation. Then the speculation gets sour, you have higher volatility, and then institutional investors, they step in and then they dump the stock, because they see that it's the usual messing around of bad management and speculation, more or less. So yes, also Unipol comes up as a very volatile stock. That's the insurance company. And yeah, we have here an historical annualized vol 45%. The range in the past 30 to 90 days has been 19 to 31%. We have a rolling average between 24 and 31%. So it's volatile because it's a stock, it has to be volatile. But it comes up as a risky tail risk stock to have. Okay, Jump-Diffusion Model is not that bad. So okay, so so basically I can take the data here, or this volatility data, and compare it with the Jump-Diffusion model. I can go back here and see what are the var numbers of this data, and also show you some other volatility charts that I have, so to give you an idea. Okay, so let's see what we got here. Ion, okay, NL, okay, that's utility. We don't mind about utility. Oh, that's example that that's the ING, the Dutch bank. You see those VAR and EVT numbers, they are huge. 5% expected shortfall, 9.4%, and you have here a 14 to 27%. These are huge numbers, huge. There's huge tail risk, and that stuff happens once every 2 years, 10 years. It doesn't happen with a lot of frequency. Okay, so let's take again Kering, a luxury department, and the VAR 95, it's a very modest 3.18%. So there is a common 5% probability that Kering is gonna give you a 3.2% loss in one day. and a 5% probability, it's a considerable probability, although 5%, it's a 5%. It's not a 0 something, with 0.00 something. It's 5%. 2.5% probability keying as a drawdown in one day of 4.24%. And then we have VAR 99 of 5.8%. And that's the very tail risk. It's the 0.1 probability that keying draws down of 10.25% in one day. And my dears, you can see here, you see here 0.10. So you have quite a few peaks over the threshold here for keying. So it's not really uncommon that keying, that's the tail risk, that's the risk management, that's the tail risk, because it's in the data, it's in the past performance of the stock price. It's not uncommon that keying violates a VAR 99.9. Okay, so the 0.1 probability that one day you have a minus 10% shock in the price is not really uncommon. You see how many spikes we have here. 2008, 2003, and here 2020. Okay, but we have past volatility here, the beginning of 2025 or this year, or in 2024. We have two times we have a VAR 99.9, and it's well in excess of 10%. So we are going into the realm of the expected shortfall of 13.8%. I mean, if I'm a keying investor, keying equity investors, okay, we have to make this simple mathematics. Okay. Okay, come on. Keying share price 205 euros. I want 1,000 shares. Okay, so I'm spending 205,000 euros, 200k. Okay, let's see. In one day, I have a minus a VAR 99.9. That's a 22,000 euro loss in one day. Okay, that's what I'm talking about, the monetary numbers. Yeah, it's a very large loss. It's very large. It's very, very large. Okay, because if you invest 200,000, yeah, 205,000, and the stocks, basically, you go to sleep, you are very happy, you are rolling on some gains, and then the stocks shaves in one day 10% of gains, and then you are 22 grand under. That's not pretty. Yeah, from I don't know how can you manage that sort of risk. Okay, so I mean more. Yeah, if I have 10,000 shares, yeah, that's 2 million euros. Okay, let's assume that we go here well in excess of the 10%, and we go towards the expected shortfall. Okay, and I have a 13.8% loss in one day. It's 83,000 euro loss that you take on your portfolio in one day, in a few hours, mate. All right? That's huge. Okay, I mean, even if I don't know, Goldman Sachs or JP Morgan, or I don't know, BNP Paribas or Societe Generale, whoever, Deutsche Bank, you're managing ENG, you're managing an equity portfolio, and suddenly keying jumps and it gives you a 10, 12, 13% loss in one day. It's big stuff. It's a huge loss. And the blue lines all above the red line here, the dashed red line, these are very extreme VAR numbers. Yeah, these are very huge loss. We are talking about tens of thousands or hundreds of thousands, just only for one stock that basically a portfolio absorbs of loss in one day. Okay, if the stock goes down 10% in one day, you're very likely to have erased the whole year, basically gains, or you're probably in negative equity, almost surely. So that's one point. That's keying, yeah, that's keying alone. And okay, luxury stocks, that's the must-have. No, it's luxury stock is a must-have not, because they are very risky. Good lord, nowhere near keying. But yeah, Fineco Bank also. You see here a lot of volatility also in the recent past. In Q1 2025, Q1, Q2 2025. Yeah, in Q1 2025, which I predicted with my working paper. My working paper see the title of my working paper, please. My working paper, because I'm working now. Okay, forecasting market drawdowns in Q1 2025. A volatility analysis on major US indices using GARCH, VAR, EVT, and seasonal volatility models. Okay, so in December, I did this work between New Year's Eve and New Year. On the 1st of January, I was crunching numbers on VS Studio Code on Python. So for me, it's work. It's not paid by anyone. I don't earn anything. I do it for academic reasons. But I worked through, and I knew that Q1 2025, because there is the change of POTUS, there was going to be a lot of volatility. And here, Fineco Bank, just 10% down, yeah, and it's a VAR 99.9. And also, I saw that in the Q3, Q4 2024, the market was behaving in very volatile manner. And we have Fineco Bank also, it's quite volatile because these are stocks. So you have large institutional investors which dump in one day millions in equity, and so you have these large moves. Okay, so the tail risk is exactly that. The tail risk, it's a high risk, especially for retail investors, for people who have their savings into private pensions, in ETFs, they go to their local bank and they ask their basically the investment manager to give them some investment products. So the small investors are those who suffer the most these very large numbers, because once you are sitting on an ETF, you tell me if, and the ETF is given you by brought you by Unicredit or ING Financial Advisors or I don't know, Scalable Capital. You have your app. You are sitting on Scalable Capital. You tell me how can you hedge your ETF exposure, because you haven't got a clue of what's going on in the market. You have no risk management in place. You have no data. You have no numbers. You have no parameters. You have no idea how to measure volatility. You don't know if you see the market going up and down, or you say, okay, I'll have to wait and stomach that stuff. But basically, what happens is that institutional investors, they have the instruments and they profit from the vast majority of small investors, which are basically here. For example, we have Azimut, which is an investment company. It's a private fund. They manage fund. They are an investment firm. So they harvest savings from ordinary people, and then they give Azimut funds product. They give saving products, which are not saving products, they are financial products, which are very, very risky, and they carry a lot of risk. But Azimut in itself, as a stock, it's very volatile and it's very, very risky. So Azimut as a market risk in itself, as a company. And I find very difficult to give that I take my savings and I give it to Azimut to manage it, because Azimut as a firm is very, very risky. We have here some shortfall which larger than 15% drawdown in one day, a drawdown which are larger than 10% in one day. I mean, that's not the only stock, but to be an investment firm, I don't think that my money is safe are safe when they are parked in any Azimut fund, although they are they have a very good track record in terms of successful investment. The same is Deutsche Bank. You see how volatile is Deutsche Bank here. We have a lot of times the Deutsche Bank has violated the VAR 99.9, north of 13% loss in one day, 16% stock price loss in one day. These are huge numbers, and people they are basically they find themselves at a loss of tens of thousands, hundreds of thousands of euros or dollars when they are exposed to these stocks. So the VAR numbers, they are very, very important indeed. And now going back to the FTSE MIB stocks, I have another work here which is very interesting. Okay, let's see which data I have. Yeah, FTSE MIB stock and prices. So with that, I've implemented a very simple thing. So I take the data, and I have an Excel file, CSV file, with the beta data column. You see beta, price to earning ratio, the last price, and I ask Python to work through the stock price correction or uplift when I have to normalize the stock price to a 12 price to earning ratio. For example, here we have A to A, first in alphabetical order. The market price to earning ratio is 8. The last price was €2.20. So normalizing the price to earning ratio, it means that instead of having an 8.4 multiple, if I give A to A 12 multiple, the stock price will have to go up by 42.5%. Okay, so not all is negative, because not all stocks have a very high, have an inflated P ratio. So if A to A it's worth its price €2.20 and it needs a 42.5% uplift, that's a 93.5 cents plus 2.2, we are talking about 3.13 cents, 3.14 euros. Okay, so it has a 90 cents upside, which is small, but I mean, I think if I'm Leonardo DiCaprio in Wolf of Wall Street, I would say, okay, either way is a huge 40% upside. You're gonna gain 90 cents on the dollar, something like that. But anyway, what I want to show you is that even some unknown corners of the earth, which it's the Italy stock market, Italian equities, there are some stocks which have very bloated price to earning ratio. That's another luxury stock, Brunello Cucinelli, 61.96 price to earning ratio. And I say it again, Campari, they sell the Aperol Spritz, it's very nice, but the price to earning ratio is 36.4 and the stock price is €6. We are talking about a fair price around 2-3 euros, so even less, because to normalize the P ratio, the stock price will have to adjust by 67%. Also, Brunello Cucinelli, the stock price will have to adjust by 80%. So, considering that the stock market, the stock price was €180, 80%, we are talking about €28 or thereof, around 20-30 euros. So it's a huge chunk that potentially the huge tail risk for which the stock is prone to that tail risk. So it's the huge chunk of the stock valuation that can be eaten off. And then the investors, they take profit because the stock is too expensive. And here, Diazorin, price to earning ratio 25, ENI, and ERG, which are two energy companies, they have a slightly higher multiple. So the market is pricing a higher stock price because it's the energy sector and it's very volatile. So if energy prices go up, then investors they are willing to pay higher multiple. Deutsche Bank, it's a 15 price to earning ratio. It can grow, but it's already, we have tail risk in this puppet. Data Logic, this is very much a function of the AI bubble, because we are at 156 price to earning ratio vis-a-vis a €4.70 stock price. So that means that 156 price to earning ratio, that means that the earnings of Data Logic, they are very small. And let's see if I can price to earning ratio. Price to earning. I have the ratio. Okay. So if I have 4.67 divided 146, or let's do 4.7. Okay. Price to earning ratio. So I'm trying to the earnings. Okay, price to earning ratio. 1 second. Yeah, the price to earning ratio. I was lost, but I didn't do any wrong. So basically, if I take the ratio between the PE and the stock price, I have an earning parameter of 33.1. Nevertheless, we can go on here and basically Diazorin, dividend per share €1.20, the dividend yield. Okay, let's see the profitability. These are the ratios here. Net margin, let's see the income statement. Okay, so revenue growth 3.2%. Okay, yeah, the net income it's 188 million. So for a company who turns out 188 million net income, which still it's positive income, but basically the market is pricing a 156 multiple on the of the net profitability of the company. So it's not a company that is turning a billion or 2 billion a year in a net income. That's why the multiple is very high. No, sorry, not no, data logic. We are talking about data logic. My bad. Sorry about that. I start to be very tired. Yeah. Okay, we see. Yeah. Okay. We have an operating income of 348,000, Mike. So, yeah, there we have. And net income 2 million. So it's a very tiny profitability margins. And that's why we have here a data logic 156 price to earning ratio, right? The beta of the stock, it's 1.43, and the stock price, the most recent stock price is 4.7 euros. Let's see what we got here. Overview. So that's why it's 4. Today it's down minus 2.21%, which is very EPS growth minus 80%. So earnings per share, they are not growing, and it has a huge multiple. I think that's a carry through of the AI wave, the AI bubble, the artificial intelligence bubble. So 156 data logic, it has a lot of risk. Okay, let to shave. We have a 92% stock price that will have to be decreased or adjust, and stock price is 4 euro. So there are bubble elements in Italy which have some huge price to earning ratio, and those for sure will bring some Philips 80 price to earning ratio. Those for sure will determine a lot of volatility. Louis Vuitton 19 price to earning ratio, and it can be very volatile as well. Let's see, this telephone. So STM Microelectronics, we saw before, it's 26 price to earning ratio, and so that's a stock that can have a lot of correction. SAP, SAP also very large price to earning ratio. The Siemens, well, it's Ferragamo is a negative. Safilo, those are French. Unicredit, I think more than a valuation, Unicredit tail risk, it's a volatility tail risk, which is linked to the whole commerce market, Mambo Jumbo. Regordari is 26 price to earning ratio, Prismian. So there are elements from a valuation standpoint, which is not volatility, from a valuation standpoint, which show that we prove that stocks which are Leonardo, which is a defense stock, now is being pumped up to 24.5 price to earning ratio. So from a valuation standpoint, individual stock that have a higher than average price to earning ratio. So that element also brings the it's a factor that can determine an overall correction in the equity market. Then we have the volatility component of these stocks, and we have the tail risk element of this of the stocks and of the FTSE MIB, which are quite elevated. Yeah, it can be very volatile. There is a lot of tail risk in those equities and in the FTSE MIB as a market of stocks and equities, of stocks or equities, which are the same thing, so basically. So that's why I believe that it's very probable that we can have a 15% drawdown, and we are going to have a market period of volatility, a quarter of volatility going into Q4, Q3, Q4. So there is, of course, uncertainty around the government factors. I don't think they're going to last any longer. But let's see some other volatility factors. Okay, so when I do the other volatility models, we can appreciate some other stuff. Okay. And we have our very good example, which is Kering. If I will pick a stock to short, it's definitely Kering. Or LVMH also, I will short it. That's for sure. BMPS, I will short it. Then I don't want Data Logic, I will short it for sure. Also Unicredit, probably I will short it. Those are very risky calls that I'm making, but I want to show you the recent volatility in Kering stock price. So bear with me, which is here we are. Okay, Kering. You can see here that the 20-day, 60-day vol, you have an uptrend of volatility build up, and that's confirmed also in the GARCH and EGARCH models, which are more sophisticated because it's conditional volatility, but it tracks more or less tracks the volatility of the stock, and you see that there is an uptrend in volatility for Kering. So I think this can be a short, a stock to sell short or to hedge the tail risk of or market risk of having Kering in a portfolio. LVMH somewhat starting to move also in volatility terms. Okay, we have here Moncler, analyzed vol 20% or more than 20%. Okay, Prismian, somewhat of teacup in volatility that comes from basically it's a tail effect, it's a lagged effect of the Q1 volatility that we have seen in 2025. The start of the year drawdown. Ferrari, it's much safer investment. Ferragamo probably is gonna be a lot volatile. And let's see. Okay, Stellantis. So Stellantis, it's a pitiful case because Stellantis in itself, it has a very small price to earning ratio. It's a 4.7 price to earning ratio, and the stock price it's €8.75. So basically, the company is being crushed, totally crushed in the market. Let's see the volatility numbers. Okay, Stellantis, we have it here. Okay, so it has a daily vol of 2.5%, and the recent volatility has been between 43 and 47%. So the stock, it has been crushed. The historical volatility, the rolling vol, it's 35 to 44%. So the stock has been actually crushed, and we can see it here in the trend line of the chart. The annualized vol is gone up to 40%, as it also says in the Excel file. And so it's nevertheless the price to earning ratio is 4 point, so it has a very tiny multiple. So it means that investors, they are not very willing to, they don't want to invest into Stellantis. They are selling, they are dumping the stock. The company is getting crushed basically from an equity standpoint. And I don't see volatility, it only goes up. When it builds up, I think that annualized volatility can go from 40 to 60 to 80%. So still tough times for the automaker. And STM Microelectronics, it's a perfect stock that you could short also on the back of the AI bubble, because we have a large price to earning ratio, which is around 25, 26, and the stock is volatile. You see the conditional, the historical vol, it's 40 to 60%. Also the GARCH and EGARCH model, they tell us that, the chart tell us that we have seen a recent upside in conditional volatility. So probably there will be a build up of volatility once then we are going towards August, September, October. Then I think we will have a build up of volatility, especially when we have the whole tariff story unfolding. The market is going to become very, especially European equities, they're going to see outflows because they are on the receiving ends of tariffs, and so the market is going to be very volatile. And these stocks, STM, Stellantis, Montepaschi di Siena, Unicredit, Kering, LVMH, Mediolanum Banca, Banca Mediolanum, and all that Mambo Jumbo, they're going to be volatile. Yeah. They can have some very large price shocks, large daily price shocks. So that's very helpful to have these charts, because we see the recent past volatility, and when we see that there is a building trend of volatility here, for example in STM microelectronics, we can presume that we can carry through the information, the data point, or the clustering of data, and we can, according to how the market investors basically behave in the market, what is the price discovery mechanism, we can see that basically if there are factors that will lead to the conclusion that the market is going to be in a drawdown period, in a correction period. So I have other models here where I have basically created the volatility moving average with the volume. Okay, so in the ordinary chart you have the moving average, and you can attach the volume. Let's see if we have a volume profile here of some sort. Come on, boy. Oh dear. This machine doesn't want to cooperate. This machine, it doesn't want to cooperate. Oh dear. It's 21st century machine. It doesn't want to cooperate. Oh dear. Oh dear, oh dear, oh dear. No, okay. So we cannot have the volume profile. But anyway, so basically what I'm saying is that you have technical indicators like the Fibonacci retracement, etc. And you can measure the volume of transactions. Okay, what I created, instead of the simple moving average, I have the volatility moving average interpolated, so which it's in the chart. I have the volume data and the volatility moving average data. I think that's a very good instrument. I'm sure it's very good. I like it because I can see stuff that when you open a trading terminal you cannot see. Although it's not a live thing, a live API thing, but nevertheless it's very important, because I can see here general insurance, like the 7-day vol moving average has crossed the 21-day moving average. I can see some volume bars which in the same, more or less in the same periods in the previous days, we have a spike in volume, and then you have a pick up in volatility, a tick up in volatility. So you see that those things, they work together. Okay, so you have a correction in the price, probably, I don't know, people that they don't like the insurance company and they dump the stock. So here I can see the volatility moving average. Okay, BNC Speaker, which is a stock which is listed on the FTSE MIB. We can see here the moving average. We have an uptrend in the volatility moving average. That's very interesting. Or again, Generali Bank. Okay, it's down there. We don't need it. Banca Monte dei Paschi di Siena. Okay, so we have this volatility moving average. It's a 2-year time frame, like beginning of 2023 up to date. And Banca Mediolanum, we see we have a bottoming of the trend and somewhat going up. We have this here, Banca Mediolanum, we have this big bar here. You can see here in volume. So somewhat a very large volume. And there are no large volumes building up, but we see that the volatility numbers, the moving average is changing the trend direction. It's going towards higher vol. Okay, we are going towards the 20% annualized volatility. So that's gonna be very interesting to see. Also BMPS, we have already the moving average, it's above the 20% vol. So these also are very interesting charts. Again, Banca Popolare di Sondrio, we have here across the 7-day, across the 21 days, so somewhat probably higher vol, although the chart is not very nice. And BPM, another bank stock. Also we have a slightly trending up of the volatility with some larger volume, more or less, and so forth and so on. We can see BPER Banca, so the bank stock, they are becoming more volatile. We have some sort of here, some larger volumes than ordinary. You can see lower volumes, and then we have a collapse in vol. Then now we are having a build up in volatility. The trend is pointing higher. The short-term volatility, the 7-day, it's slightly higher for BPER. It's another bank stock. So we are having a short-term volatility effect building up in these stocks, which is good for speculation, those that want to short stock and profit from the volatility. So and then the volume, it's an important factor for the liquidity that's in the stock. Credit Agricole, another bank stock. Okay, we see here volume of to 20,000. And then here volume, the nearly, okay, it's 100,000. So we have some parameters, and we see here higher volatility also for these two stocks, Credit Agricole and the Danieli. It's another company, it's an Italian company. So short term, we are the chart tells me that there has been a change in trend in the 7-day and 21 days rolling average volatility, and that's an interesting instrument to have, so that any trader can plan and see which stocks are good for buying that stock, or which stocks are potentially a risk, at a tail risk of volatility tail risk. They can have drawdowns, so you need to hedge the risk, or you want to short the stock. So here NL has been slightly volatile in the past periods. ERG, some volatility, ERG, okay, Euro stocks, the whole index, Ferrari, not so many volumes. You can see here, like the Euro stocks 50, how the volume is more consistent than a single stock. And so that's a very useful tool. So I have to love you and leave you, because basically my research, it's as I said at the beginning of the video, it would take days of study for all the data that I've been working through. Okay, here for example we have a very good example of volatility. Okay, so what do we have here? We have a table, the top 10 stocks of a 21-day rolling average vol, and I've included in the code also the drift. So vis-a-vis the volatility, what can be the daily percentage change with that volatility, plus or minus. So we have Iveco, Santander, Ferragamo, Montepaschi Siena, STM Microelectronics, Saipem, Kering, Telecom, Leonardo, Stellantis. Okay, those are the stocks with the higher 7-day and 21-day rolling standard deviation, and we are talking about a 2.3 to 2% on average, or 2.5%, 2.6% daily move up or down. Now, eventually, when the volatility goes up, you are talking about a drift lower or a drawdown of 2%. So that's a very useful measure, because in volatility terms, I know the volatility, but then it's very, very useful to know how much the stock is going to go up or down. And we are talking on we are not talking, I mean, the data on average, Iveco, okay, it's 2.38% for a 7-day rolling average in standard deviation, and 2.66%, okay, in proportion to the parameter, okay. So the average 7-day standard deviation for Iveco, it's 0.3785. That basically translates in a daily percentage change of 2.38% on the stock price. Okay, so that's the usefulness, the utility of this thing, that basically it transforms the volatility parameter, the standard deviation parameter, into the daily drift of the stock, which is consistent with the whole concept of the stochastic differential equation, which has a mu parameter, which is the average price, which is the drift parameter. It has a standard deviation parameter, and it has a error term parameter. And those are basically, it's a differential equation because you have a time element, okay? So you have the mu parameter, the sigma parameter, and error parameter. Those parameters they work. Also, they have a time dimension, and then you have basically the differential equation, and basically you take the first and second derivative with respect to time of the average price or of the volatility, and then you see a time t+1, t+2, or when you do linear regression, which is not a differential equation, but you see a time t-1, you regress, you see the lagged values, then what models through. So that's very useful. Like Banca Montepaschi Siena, yeah, we are in the range of 2.27, 2.4 daily drift when this volatility basically kicks into the stock. And I can take the data and I can compare it with the VAR numbers. So The VAR numbers, they are those large one-day loss in the stock price, the large jump in the stock price. So you have a sharp sudden shock in the stock price and a large drawdown. The method that I have here, it's more linked to the random walk of the stock. Okay, so it measures the drift. It doesn't measure the extreme value of the stock, the large one-day loss. It measures the drift when there is higher volatility, because it's a plus or minus. So the stock can go up 2%, of course, instead of going down or going down. So it's more. It's most of the time stocks go up, don't get me wrong, but the average drift of Kering vis-a-vis these levels, those levels of volatility, it's a 2% move, 2.2%, 2.1% move drift. Okay, that's very interesting. It's an average measure that gives you a framework, a reference for understanding what to expect when you invest in a certain stocks, and then you build a portfolio. Okay, because I have also the portfolio allocation, which I can show you. I didn't spend too much time on the portfolio allocation, because it's not something that I usually do, but I reckon that it can be useful to see for some people. You have to bear with me because I need to find it. The code is extremely lengthy. Okay, so here we can visualize a max, a Sharpe ratio, a risk parity, and an equal weight allocation. Okay, so what do we have here are the 40 stocks in the FTSE MIB. Most of the stocks they are blue chips Italian equity in the FTSE MIB. There are some other stocks, we saw it before, like Deutsche Bank, Societe Generale, Santander, LVMH, Kering, and so forth and so on. And then we have the benchmark, which is the FTSE MIB, FTSE All Share. We have two EDF, which replicate the FTSE MIB. Then two European, I have a Euro Stocks 50 and then MSCI Europe as ETF. So as broad as possible, the reference frame. And so what delivers the highest return is the max Sharpe ratio, because the Sharpe ratio is the ratio for the profitability vis-a-vis the volatility of the stock vis-a-vis the volatility of the market. So so the max Sharpe ratio, it's a 54.31% return. The time series is a 20-year time series, so it's not 54% in 1 year. And you see here 60 are the financial assets included. The risk parity portfolio is 25%, equal weight portfolio is 23%, the market return are 10%. And the volatility numbers are this. So we have a 14% vol for max Sharpe ratio or equal weighted portfolio. The risk parity portfolio, it has a higher vol of 18.8% and 25% return. So, and the allocation according to the Sharpe ratio, it's very much concentrated into these stocks. Okay, so it's 20% for Danieli & Co, and then ING, Poste Italiane, Ferrari, Banca Mediolanum, Moncler, Intesa San Paolo, Generali Bank, and Bruno Cucinelli. But we saw that Bruno Cucinelli has a very large P ratio, so it's reasonably the allocation is tiny. So I can presume that it would be a good portfolio allocation. Risk parity portfolio, of course, it extends the number of stocks for which you spread the asset allocation, because they are measured. The allocation is measured according to the risk factor, which is the volatility factor. And so more stocks, they are included in the portfolio allocation. And you have Saipem. So what happens is, for example, that Saipem is an energy company, so there is a larger allocation towards energy, let's say, something like that. Or we have here ENEL, so it's utility company. So it's a more, it's a safer company, because utility companies, they tend to be less volatile. So what the stocks that are excluded is Deutsche Bank, the bank stocks, UniCredit, ENI, so it's very strange allocation that's done in automatic, LVMH, so I don't have a clear explanation for that. And then equal weighted, so it's basically 60 stocks and allocate an equal weight to all the 60 financial assets. And here we have the efficient frontier of the portfolio allocation. So max Sharpe ratio, risk parity, equal weighted. So those are the parameters that we have. And okay, you see the risk contribution for the different portfolio allocation. So weights versus the risk contribution in a risk parity portfolio. It's very interesting. And equal weight, we see the risk contribution. So Bruno Cucinelli is 3% risk in the equal weighted portfolio compared to the Eurostock or something like that. It's very interesting. Let's see if I can find anything else. Anything else, mate? Anything else? Anything else? Okay. Oh, we have a pie chart. Okay, so I think that we will. Let's see if I have a CAPM on top of that. And so I've showed you also the CAPM allocation. No. Okay. I can do without the CAPM allocation. Okay, let's see. What are the results here? Okay, what do we have here? It's data range 2006-2025. So an equal weighted portfolio, that's the allocation in 10 stocks from Santander, Gateway. Okay, that's okay, but that's alphabetical order. No, never mind. So the risk parity portfolio. So the average allocation is 2.4% for an equal weighted portfolio for each asset. Then the risk parity portfolio, we see here that SNAM and Terna is 4.2%, Recordati and Campari it's 3.4%, EG. So there is a larger component I see here of energy companies, SNAM, Terna, EG. So that's interesting. And here we have other performances. Portfolio performance, it's 9% return on year. The equal weighted, the risk parity, it's 9.6% yearly return vis-a-vis a volatility, 21 or 22% volatility. Risk return ratio, it's 0.4, 0.45. And we have here the portfolio concentration analysis. The top 5 stocks, we have a concentration for the risk parity portfolio of 19.5. The equal weighted portfolio, of course, is 12.2% because equally weighted. And okay, so we have the pie charts. Those are the other stocks, and the risk parity portfolio, those stocks which have the larger allocation are this one. So it has a 2.8% on MSCI Europe as an ETF. Then we have Interplan, Amplifon, Ion, which is I don't know if it's an energy company. ERG is an energy company. ICEA is an energy company, probably. Campari, it's a consumer brand. Terna and Snam, it's a energy company. So it's more skewed on the energy side of the economy. So we see here equal weight risk contribution according to the stock. We see that on this occasion UniCredit brings the most risk into the equally weighted portfolio. And then okay, risk parity here. So those are very, very interesting. I want to actually see if I can extend the okay, year 2000. Okay, the data, they are from the year 2000. Let's see if I can implement the allocation from the year 2000. Is there any way I can sort out the code? Okay, never mind. I will I'll double check later. I said that I didn't spend too much time on this stuff. So if you want some risk parity, equally weighted CAPM portfolio allocation, drop me a message. I will send you all the parameters, all the pie charts, and even the Python code if you like to. So remember to follow this channel, subscribe, thumbs up, give me a like, and be prepared because we are going to have a correction which is well on its way also today. And yes, see you soon for the next episode. I think I'm almost sure that I will start to provide some more content in which I will do some individual equity analysis of any individual company in terms of the balance sheet and discount the cash flow model, the dividend discount model, Gordon growth model, so that I can see which stocks are potentially good investments, which stocks are overpriced or underpriced, and build some arbitrage case for arbitrage or going long that stock and short that stock. So with together with the volatility component, I will do follow my channel, because I will bring you more and more interesting and actionable content in terms of equity stocks, equity analysis, and I will provide you my research free.